moving forward for, oh, now we are, never mind.
We are now, yes.
Yeah.
So welcome everybody who's just tuning in. We are waiting just a few moments to get our agenda up on our chat. But while we're waiting, why don't we go ahead and do committee introductions. So I will start with Representative Fay.
Thank you, Madam Chair. I'm Representative Jessica Fay. I represent parts of the towns of Raymond, Poland, and Casco. House District 66.
Great. And Representative Fecto.
Good afternoon. I'm Representative Justin Fecto of Augusta, House District 86.
Thank you. Representative Hymanson.
I'm Representative Patty Hymanson, House District 4, which is parts of York, Wells, Sanford, and all of Ogunquit.
Representative Corey.
Good afternoon. I'm Patrick Coy, represent House District 25, which is part of Wyndham.
Thank you. Representative Cardone. I can't hear Representative Cardone. Let's move on to Representative Cloutier.
Hi, I am Kristen Cloutier and I represent House District 60, which is part of Lewiston.
Thank you. Representative Arata.
Hello, my name is Amy Arata and I represent District 65, which includes New Gloucester and part of Poland.
Representative Martin.
Hi, John Martin, District 151, Northwestern Aroostook County.
And Representative Millett. Can't hear you, Solon. You might have to turn off your mute. There you go.
Solon Millett, House District 71, towns of Norway, Sweden, Waterford, and West Paris.
Thank you. Senator Davis.
Thank you, Madam Chair. Good afternoon, everybody. My name is Paul Davis, and I represent Senate District 4, which is all of Piscataquis County and parts of Somerset and Penobscot.
Senator Bailey.
Madam Chair, I'm Donna Bailey. I represent Senate District 31, which includes the city of Saco and the towns of Old Orchard Beach, Hollis, Leamington, and part of Buxton.
Great. And my co-chair, Representative Peirce.
Hi, I'm House Chair Teresa Peirce. I represent House District 44, which is the majority of Falmouth. And I think Representative Cardone is just coming online.
Great. We are joined also by our OFPR analyst, Maureen Dawson. And my name is Kathy Breen. I'm the Senate Chair of Appropriations. I represent 6.5 communities in Cumberland County. And wondering if Representative Cardone, if you could introduce yourself.
Barbara Cardone, House 127, part of Bangor.
Thank you. And we do have our agenda up in front of us. Well, it's up to you if you put it in front of you, but it's available in the chat. And today's appropriations meeting is the last in some what I would call generally orientation, background education, that sort of thing for committee members. And we're going to be, before we start public hearings next week on the governor's proposed supplemental budget. So today, this afternoon, we're going to be looking at some of our economic development efforts in the state. And some of them have to do with tax incentives. Some of them have to do with state agencies that work with entities in the state to lend money, to seed startups, that sort of thing. And lastly, we're going to hear from Commissioner Johnson, who also will be giving us an overview of some of the economic development efforts that we have going on in the state. So first up is Dr. Michael Allen. He's an associate commissioner in DAFS for tax policy, and he oversees the Maine Revenue Service as well. And he's going to talk to us about the tax expenditures that we make through, well, they're tax credits or tax exemptions. So they wind up not coming in to the state, but they are sort of impactful to the general fund in the long run. And so he's going to cover the topic sort of generally, but then also one of our collegial committees is called Government Oversight. Some of the members of appropriations have been or currently are sitting on that committee. And that committee some time ago tasked its staff organization, which is called OPEGA, to do some review of the state's tax expenditures and see what kind of results we're getting for those tax expenditures. And so the staffer who's in OPEGA working on that, and two of them, Matthew Kroc and Jennifer Henderson, will be joining us after we hear from Dr. Allen. So with that, I am going to ask, okay, good. I see Dr. Allen is ready to go. Are there any questions from the committee on today's agenda or how things are going to flow before we turn the floor over to Dr. Allen? I'm not seeing any. So I think we will proceed. And I think what we'll do is have Dr. Allen do his piece, and then we'll take questions to him before we move on to our OPEGA folks. Hi, Dr. Allen. The floor is yours.
Pardon me?
The floor is yours.
Thank you. Thank you. Good afternoon. It's recently, I recently became aware that when I do these presentations, I have my laptop with the camera to my left, but I have a big monitor that I work off of because I'm always working on spreadsheets, and I tend to focus more on the monitor than I do the laptop. So if it looks like I'm kind of gazing off, that's why I'm doing that. I can see everybody's face much easier. All right, so I'm going to pull up the presentation. And hopefully everybody can see that. And I did send it to Maureen, but I sent it rather late, so I don't know if she was able to get it out to you.
I think it's in the chat for folks who want to see it. Thank you.
So I've been doing this kind of work for 30 years. And this is the first time I've ever done a formal presentation on tax expenditures. So it's tax expenditures, probably only tax economists can get excited about tax expenditures and discussing them. But I'm going to try and make this as painless as possible for you. I'm going to talk about what the purpose of the tax expenditures reports that are required in Maine statutes are. Then what the purpose of a tax expenditure report is, I'm sorry. Then I'm going to talk about what's in Maine law as far as requiring tax expenditure reports. I'm going to spend quite a bit of time talking about identifying tax expenditures, because I think that's probably the area that's most not understood well about tax expenditures, and will help explain why the tax expenditures that we present in our reports are in them, what the goal is of putting them all in there. Talk a little bit about how we estimate them and how to interpret the estimates. Go through some of the income tax expenditures, then the sales tax expenditures, and then just two quick items at the end, one being the main tax incident study. And the only reason I'm going to mention that is because it's included in our Red Book report that we do for the Taxation Committee and for the legislature in general. And then talk about what you're going to be hearing after me, and that's the OPEGA tax expenditure evaluations. So what's the purpose of a tax expenditure report? Well, I think Senator Breen put it perfectly at the beginning. It's to recognize the fact that there are expenditures that are taking place outside of the normal appropriations process through the tax system. That is a so-called tax expenditure. There are subsidies, there are incentives, other aspects of the tax system that basically could be achieved through a direct appropriation to somebody. And the concept of a tax expenditure report came about at the federal level back in the 40s, 50s or so, that when Congress was evaluating the president's budget submission, they should also have an understanding of what expenditures there were within the tax system. And so the idea of a tax expenditure report came up. And since that point, most states have joined in, just like at the federal level, of providing some sort of tax expenditure report on somewhat of a regular basis. In Maine, we have two tax expenditure reports that are required by law. The one that AFA is probably most familiar with, and it's included as part of the governor's current budget submission. It's Part R. And you can see in the first sentence there, it says that the governor's budget must include a part that asks the legislature whether it wishes to continue funding each individual tax expenditure provided in statute. So just like you go down through the governor's budget submission and look at each appropriation line, the idea is that you should be also looking at each tax expenditure and determining, yes, we would like to continue this, understanding that there are certain revenues that are foregone by continuing to allow these expenditures. The governor's budget submission always includes a table with our estimates of the tax expenditures. It usually goes in the governor's budget overview, and that's certainly the case with the governor's recent budget submission. It's not a lot of detail. It gives you the section of law that creates the tax expenditure. It gives a title to it, and it shows you the estimated revenue that's foregone for the current biennium and the upcoming biennium. The other report is the one that goes to the Taxation Committee every 2 years. It's due February 15th, so in a few weeks. And it's essentially the same thing as what's in the governor's budget submission, but it puts a little more meat on each of the tax expenditures. So it gives a little bit of history, gives an explanation of what the tax expenditure is, what one is estimating or thinking the purpose of the tax expenditure is, how many taxpayers we think are being affected by this, that sort of information. And that's what has traditionally been called the Red Book, because for a number of years the cover on it was red, and that's the way everybody's become familiar with it. So from this point on, it's red, and that's the way we'll talk about it oftentimes. And again, I'll just talk about this quickly at the end, but just so you know, in recent years, there's another report that's also due February 15th, and that's the tax incidence study. And that's a look at the total state and local tax system and our attempt at trying to estimate what the burden of that state and local tax system is on Maine resident taxpayers. So it shows you, by income category, who's bearing the burden of the income tax, of the sales tax, of the property tax. How much of our taxes are exported outside the state, so isn't borne by Maine residents. It's that sort of detail, and we've started including it in the Red Book so that the Taxation Committee has both of those reports in one document. Also, you can see here at F of this section also requires us to include a list of the most recent recipients under the Better program. Again, that was a separate report at one time, and a few years back, we talked to the Taxation Committee if we could just report it within the Red Book, again, so that all this information is in one spot for the committee and legislators to review. So this is pretty common, again, at the federal level and across states. I would say the report here that's in Title V is somewhat unique at the state level. When I worked in the U.S. Treasury Department prior to coming to Maine, I did tax expenditures that went into the president's budget submission to Congress. So just like at the federal level in Maine, the governor's budget submission has to have this listing of tax expenditures. I get the feeling from talking to colleagues in other states that not many states have that requirement. Most states have something similar to the requirement in Title 36, that there be some report on a regular basis of what the tax expenditures are. All right, so identifying tax expenditures, and if you look back at those two statutes, they describe what a tax expenditure is. It's a credit, it's a deduction, exemption, and exclusion, but they really don't give us any direction on what are they a tax expenditure to. In doing a tax expenditure report, the starting point is, well, what's sort of the baseline or benchmark law that we're considering that we're going to make a determination that this is or is not a tax expenditure to. I think the normal kind of view of tax expenditures is, oh, I can go into Title 36 and I can see this sales tax exemption is listed here. So that must be a tax expenditure and it should be in the report. And that's true. We do include it. But really, our tax expenditure report is really a combination of a bunch of objectives. And I'll explain what I mean by that in a second. So again, tax expenditure reports came out of the federal level. At the federal level, the income tax is the workhorse of federal revenues. Yes, there's payroll taxes and estate taxes and some excise taxes, but it's the income tax that's generating most of the federal revenue. And so all of the early research and development of tax expenditure reports came out of the federal government, and it's focused on the income tax. At the federal level, the Office of Tax Analysis and the Treasury Department provides tax expenditures, as I said, that go in the president's budget. For Congress, it's the Joint Committee on Taxation that develops tax expenditures for Congress to review. And there's a lot of overlap between those two reports, but I can tell you that there is disagreement on what is a tax expenditure and what isn't a tax expenditure. So while there's a probably 98% overlap between Treasury and Joint Committee, there is some differences because they're within the economics profession. There can be sort of this disagreement on whether it is or not a tax expenditure. Normally, you'd start off with what's called normal law. What is it that we're looking at? What kind of a tax are we looking at first? And in the case of the income tax, normal law is a broad-based comprehensive income tax. If it's income in any form, it should be included in the income tax. So certainly our wages and salaries should be part of the income tax. Any increase in the value of a stock that you're holding, even if you haven't sold it, if it started out the year at $100 and it ended the year at $500, in theory, that $400 increase in its value is income and should be taxed in that year. In-kind benefits, food stamps, in theory, is income and should be in the tax base. And so if that's the starting point, this sort of theoretic comprehensive income tax, then any exception to that is a quote unquote tax expenditure. And as I said, over the years, there have been items that were previously considered tax expenditures that have slowly disappeared from those tax expenditure reports. The examples I have here is the personal exemption and the standard deduction. It's sort of been this recognition that while in theory, those would be considered tax expenditures, they've become just a part of the federal income tax that we're not going to view them as a tax expenditure anymore. The sales tax brings about a whole new level of complexity because we don't have the federal government to look to, and the economists and experts at the federal level. Federal government doesn't have a broad-based sales tax. And so there have been economists that have kind of thought about, all right, well, what is the normal law sales tax? What is it that we really are trying to achieve with a sales tax? And what should we be judging is or is not a tax expenditure against? And I think the accepted answer to that is that we're really talking about a retail sales tax, a consumer sales tax. And if that is the ideal or the normal law sales tax, then business inputs should not be taxed under a sales tax. And all goods and services consumed by households should be part of the tax base. So that really it narrows and expands what should be considered tax expenditures if that's what you're looking at. The other sort of benchmark that people use is what's called reference law. And reference law says, my interpretation of reference law is, yes, we can think about this theoretical sales tax or theoretical income tax, but we got to be practical. And maybe the starting point should be what's called reference law. What's actually in the Internal Revenue Code? What's the starting point? And any deviation from that now becomes a tax expenditure. Or what's in Title 36? What does the legislature say is subject to a sales tax, and any deviation from that now becomes a tax expenditure. Again, for the income tax, it's pretty straightforward. There's been a lot of work on it at the federal level, and again, it's actually reference law isn't all that different than normal law. There's just a few other items that reference law would consider as just part of the tax law and should not be considered to be a tax expenditure. So I mentioned here as an example, exclusion of government transfer payments, right? The federal government does not tax things like food stamps. While theoretically that should be a tax expenditure, it's become part of federal tax law. It's part of the reference law that it's not included. And so it's not considered a tax expenditure. For sales tax, our reference law is Title 36, Section 1811. There's a tax on the sale of all tangible personal property. So right away, the legislature has excluded all services from the tax base. It's just the sale of tangible personal property. And only those taxable services that the legislature has specifically laid out in Title 36 at retail in the state. And then there's a whole definition of what retail means that, again, focuses on the sale of tangible personal property. So the point I'm trying to make here is, what should be included in the Red Book? What should be included in that list that's included in the governor's budget? And the way we've thought about it over the years is just to include everything. Kind of use both normal law and reference law as our starting point to make sure that we provide as much information as we possibly can to the legislature. So in reality, our tax expenditure report accomplishes two things. One, it's a tax expenditure report, but in another way, it's really a listing of tax items that the legislature could consider in times that they need additional revenue. It becomes a list of potential revenue items in those situations where the legislature is trying to generate revenue. And again, depending upon the state, states take different approaches to this. So, I've seen some reports. I can remember one quite a few years ago that was in the New York Times. They actually went through state tax expenditure reports, and they listed, which states, in a sense, are giving away the most revenue through their tax systems. And I remember Maine was ranked fairly high. And, my impression over the years was we really didn't have a lot of big ticket item, particularly business incentives, certainly in our income tax line, and or even under our sales tax. But as it turns out, one reason why we were ranked so high is that we include in our tax expenditure report all the exemptions under the sales tax for business purchases of manufacturing machinery and equipment, fuel used in the manufacturing process. All of those are included in our report. Some states don't include those, because if your baseline is a retail sales tax, those are not tax expenditures. So I'll focus on that a little bit more when I talk about the sales tax. But again, just trying to impress upon you that just because it's kind of in this report doesn't necessarily mean it is a tax expenditure from an economist point of view. We've tried to include just about everything so that you're getting the most information you can. A few other considerations of what we do not include. First, at one time we did include the sales tax exclusion for food stamp purchases. We've taken that out in probably the last 10 years or so. That's a federal mandate that states can't tax any food purchased with food stamps. So there's a good example where, well, maybe it is a tax expenditure, but if we include it in the report, somebody's going to go through the report and say, oh, all right, I can see where we could pick up X dollars if we started taxing food stamps. Well, you can't. It's a federal mandate. So why include it in the report? There are provisions in here that the federal government has denied a deduction at the federal level because they're giving you a tax credit. And so they don't allow businesses to take the expense. Instead, they get this credit. Well, if the state doesn't give you that credit, the idea is we're going to allow you to take that expense at the state level. That's really not a tax expenditure. It's a normal part of the law, and it's just an artifact that we piggyback off of federal, and we're deviating from federal law, and so we've got to have that deduction at the state level. There are we have certain taxes on certain industries that the federal government doesn't have. So we have a finance tax on banks and financial institutions. At the federal level, financial institutions pay the corporate income tax just like a manufacturer does, or a consulting business. In Maine, banks and financial institutions don't pay the corporate income tax. They or the individual income tax, if they're a pass-through, they pay the franchise tax. So we have in our income tax a deduction for any financial institution income that is showing up on an individual's return because the financial institution is a pass-through, an S corp. That's not included as a tax expenditure because they are paying a tax. They're just paying it under a different system that the state has set up. And of course, anything that's constitutionally prohibited. So we have a credit for taxes paid to other jurisdictions. This will be an issue when we talk on Monday about the tax provisions in the governor's supplemental budget. There are a few telework or remote work issues that are included in that supplemental budget. And one of them is the credits paid, credit for taxes paid to other jurisdictions that the governor felt was necessary to have a provision on this year. It's constitutionally prohibited to double tax people for both states to tax them. And so you won't see that, even though that's a credit that's in Title 36, you won't see it in the tax expenditure report. I don't want to spend a lot of time on the next point, but we're talking about tax expenditures, and I just thought it's important for everybody to understand you can have what's called a negative tax expenditure, right? So a traditional tax expenditure usually results in a reduction in tax. It's a tax break. But you could have a negative tax expenditure, and tax systems do have negative tax systems where something is taxed more or is taxed when it shouldn't be. And so the example, there are disallowance of certain deductions at the federal level, certain compensation of highly paid employees. There's limits on how much you can deduct. That would be considered a negative tax expenditure. It should be deductible. There's really no theoretical reason why it shouldn't be deductible. It's an expense like any other business expense, but for whatever reason, Congress has limited that deduction. We have a general sales tax rate of 5.5%, but if you go to a restaurant and purchase a meal, you pay 8%. If you go and stay at a lodging establishment, you pay 9%. I would consider those negative tax expenditures. And in general, there's no theoretical reason why they should be taxed at a higher rate than the general sales tax rate. Most tax expenditure reports don't include negative tax expenditures. I've seen some that do, but just that you're aware of those. In our report, we also include what arguably could be appropriations, but because they do show up on the general fund revenue report that the controller puts out each month, we have started including them in the red book and in the governor's budget submission. So that's Better and Betty. There's that line on the controller's report that says property tax relief programs. That really isn't a state tax expenditure. It's related to taxes that businesses are paying at the local level, and the legislature has created a tax break for businesses for those property taxes that they're paying to localities. And either we reimburse them directly through the Better program or reimburse municipalities for the lost revenue through the Betty program. Those were originally appropriations. At some point, the legislature moved them into an offset of general fund revenue. But we included in the report because they're part of the revenue forecast. They're part of the controller's report. Same thing with ETIF. All right, so we've identified what we're going to include in the report as tax expenditures. How do we estimate them? Yeah, for the most part, they're estimated in a similar manner to how we do provide revenue estimates to OFPR for fiscal notes when we're looking at legislation that's going to change revenues to provide a tax cut someplace. We have our models, but each tax expenditure is taken individually. So a lot of times when we're doing, say, a fiscal note, where we're looking at a combination of changes, and there may be some interaction with other parts of that bill that are affecting the cost of the tax expenditure that we're focused on. That's not the case when we do a tax expenditure report. We basically go in and estimate if that tax expenditure and only that tax expenditure is removed, what's the amount of revenue that's currently being foregone. So we don't assume any sort of behavior. We don't assume there's going to be any sort of compliance issues. We don't assume any sort of interaction. We're just focused on how much activity is currently taking place. Do we estimate is currently taking place that this credit deduction exemption is being applied to. So while I know people look at the red book and use it as a way of estimating, oh, I could, if I put a bill in to get rid of this tax expenditure, I can generate $10 million a year. It's a good guide, but the actual fiscal note may deviate in some cases significantly from the estimate that's in the tax expenditure report for all the reasons that I talk about: taxpayer behavior, compliance issues, those type of things. Some of these, we can use our models. We have a lot of information on, particularly say on individual income tax credits. There's a line on the tax return that says I'm taking this particular credit. It's available to us. We can do a good job of estimating the foregone revenue loss of that tax expenditure. Others are much more complicated because we just don't have the information on the tax return. This is definitely the case in sales tax. I mean, if the legislature in most cases has set up a sales tax exemption or an exclusion under the sales tax, we don't get any information on it. We really are taking guesses based on data, both at the federal level and some other data at the state level. But it isn't like a business says, oh, I sold, a liter of Coke and that's taxable. So here's the tax I'm reporting on that liter of Coke. And, oh, I sold a bundle of carrots and that's sales tax exempt. And here was the value of that. I mean, we don't see that. All we see from a seller is, here's our total sales. Here are our exempt sales. Here are, at the end, taxable sales. So we don't have a lot of detail on that. In some cases, there's just such a lack of detail that we put ranges on it, and you'll see that in many cases. Okay. All right, so let's start just focusing in on the two main areas. The income tax first. So we really do follow the conventions at the federal level, and in particular, the Joint Committee on Taxation, to identify federal income tax expenditures. Our income tax starts with the federal Internal Revenue Code. We conform every year to the Internal Revenue Code. In the case of the individual income tax, we conform to federal adjusted gross income. That's sort of the front of your 1040, individual 1040. That bottom line on the front of the 1040 is your federal adjusted gross income. That is the starting point of the main income tax. And again, on Monday, that's going to be the discussion we have, the change in date from December 31st, 2019 to December 31st, 2020. For corporate income tax, it's federal taxable income. That is the starting point. And so any tax expenditures that are embedded in FAGI and FTI, we include in our report so that through conformity, the legislature has also conformed to these tax expenditures. that have been identified at the federal level. Now, we certainly have state-specific income tax expenditures. So we start off with federal AGI, and then we have what's called subtraction modification. So these items are taxed at the federal level, but the legislature has decided that they're going to provide a deduction on the state return for those sources of income. So the two examples I have here is the can't see it. Social Security, right? The deduction for Social Security. So at the federal level, some Social Security can be taxable. In Maine, the legislature decided that we are not going to tax any Social Security at all. So that's considered to be a tax expenditure in our tax expenditure report. We also have a deduction for pension income and a full exemption for military retiree pension income. All of that's taxable at the federal level. At the state level, that's considered to be a state-specific tax expenditure. State tax credits, we have a credit for educational opportunity. So that's basically a student loan credit here in the state. There is no federal credit like that. That is considered to be a tax expenditure. Pine Tree Development Zone credits, the property and sales tax fairness credits. Those are unique to the state. They are a deviation from normal law and a deviation from reference law. Those are considered to be tax expenditures. We also include those items that are tax expenditures at the federal level. And again, through conformity, we also accept those tax expenditures. And so the above the line deductions, I think we provide fairly detailed information on those. Above the line is, again, if you think about your federal 1040, you start with all your sources of income, you add that up, that's your gross income. And then there's a bunch of adjustments, contributions to IRAs and other retirement accounts, moving expenses, teacher expense deduction. Those are called above the line deductions because you deduct those from your gross income to get to federal adjusted gross income. They come above the AGI line. And we get tax returns filed by Maine residents, so we know how much Maine residents have taken in the deduction for student loan interest, teacher expense deduction, or contributions to IRAs and so forth. It says IRS, but it should be IRAs. So we include those in our report, just so you understand what the foregone revenue is from conforming to those federal deductions. There are other parts of federal AGI. The two I mentioned here are quite large, but they're not. These are tax expenditures that are at the federal level that we conform to, that normally would be included in your gross income. So the portion of my health insurance that the state pays, that really is income, that's compensation. But at the federal level, that's not taxable. It's pre-tax income, if you will. The state conforms to that, but that is a tax expenditure. It is included at the federal level as a tax expenditure. We don't see that on a tax return. It's just, it just doesn't get included. And so what we tend to do is look to the Joint Committee on Taxation estimate of what the federal foregone revenue is for employer paid medical insurance and expenses. And we scale it down to Maine so that you have an idea of how much revenue that's costing the state. Same thing with the exclusion of capital gains on the sale of principal residence. It just doesn't show up on a tax return anyplace. Certainly not any tax return information that we receive. So we scale down the federal. So that's sort of the approach on the income tax side. On the sales tax side, again, this is where, in a sense, we have a little more leeway and kind of requires us to think a little bit about what is the normal law, what should be considered a tax expenditure. And again, what the approach we've taken is we've basically just tossed everything in. So if you go back to Title 36, Section 1811, right? Our sales tax is a tax on the sale of all tangible personal property and any taxable services that are listed in Title 36. So that leaves off a whole host of services that are excluded from our tax base. If that's our benchmark, then those technically are not tax expenditures and should not be in the report. The fact that we don't tax dry cleaning services probably should not be in the tax report because it's not part of our reference law. But if our reference, if our benchmark really is a retail sales tax on all goods and services, then the exclusion of dry cleaning services is a tax expenditure. So, you know, we've included all excluded services in the tax expenditure report as a tax expenditure. Again, to provide that information to the legislature should they be interested in taxing some of these services. Under a retail sales tax, a consumer sales tax, business purchases are not taxed. If they are taxed, that can result in what's called pyramiding. The business is paying a tax, that tax gets built into the price that the consumer pays at the end, and then there's a tax on top of a tax. And so in theory, business purchases under a retail sales tax should not be taxable. So again, you could make the argument that many of these business incentives that are in the sales tax aren't tax expenditures. They shouldn't be there to begin with. However, again, Section 1811 says the sale of all tangible personal property, and then there are exemptions that the legislature has created for certain business purchases. So they're included in the report. But again, I think, you know, you can have a robust discussion about whether some of these should be considered tax expenditures or not. All right, this is just kind of, again, emphasizing what our law says about the sales tax and, you know, how specific it is about really being focused on the sale of tangible property. Our sales tax exemptions in general, we have 106 in the law as of today. These exemptions can be grouped into the following categories: exemptions of goods, so grocery staples, prescription drugs. For businesses, any packaging materials that they use in sending out their products to consumers, all of that is exempt under our sales tax, and those are enumerated. We do exempt certain services. So we tax lodging services, but then we have exemptions to that taxation: living quarters at summer camps, board that people pay to Bowdoin to live on their campus. So for anything for education purposes is exempt. Work related, if you're here in the state for work purposes and you stay more than 28 days at a hotel, motel, camping ground, you have an exemption from the lodging tax. Nonprofit organizations. So the governor had a proposal a year ago, I believe. Maine is somewhat unique. We do not have a general sales tax exemption for nonprofit organizations. Basically, the default of Section 1811 is no matter who purchases this tangible property, it's taxable. And then we have enumerated, I believe when we were looking at this last year, there were roughly 45 sales tax exemptions that applied to very targeted nonprofit organizations. the governor had proposed just having a broad nonprofit sales tax exemption for 501c3s. That was not enacted, but that's another big category. Certain establishments, purchases that they make, schools, churches, houses of worship, credit unions, political subdivisions are exempt. And then finally, kind of a catch-all category of casual sales. These are isolated transactions. They're not in the normal course of a business. The best example is a yard sale. So if next Saturday I have a yard sale and I'm selling you an old bike, there's no requirement. That's considered a casual sale. I'm not in the business of selling bikes. It's on a casual basis. There's no reason for me to collect the sales tax. There's no reason for you to pay a use tax on that. The legislature has absolved you of that. But this is a good example of where we put an estimate on this. If the legislature were to say, oh, we're going to tax casual sales, that figure that's in the red book probably would not be the figure we would put for a revenue estimate or a fiscal note, because our ability to enforce that is going to be pretty slim. And so we're probably just not going to collect the revenue that we record there. All right, so the sales and use tax, business purchases and services. Again, this would be, so the first category is business purchases of goods. So this is the category where I think arguably you could say, is it a tax expenditure or isn't it a tax expenditure? Again, we've included it. So manufacturing, machinery, and equipment is exempt under the sales tax. That's, we estimate, about $50 million a year. Fuel and electricity used in the manufacturing process is exempt. We estimate that's about $15 million a year. Packaging materials that are used in a sale is exempt. Business doesn't have to pay sales tax when they purchase it. That's about $30 million. I was trying to pick out some of the bigger ones that might stick out to somebody as being, wow, that's a big revenue loss to the state. Exclusion of services on the consumer side. So again, arguable whether it should be included in here. We include services that are excluded from the sales tax as tax expenditures. Amusement and recreational services, so golfing, skiing, going to the theater, those type of things. We estimate it's about $65 million a year. Transportation services, any sort of intrastate use of transportation services. You rent a limo for your child to go to the prom. You take a taxi cab someplace. You take a bus from Portland to Bangor, or the train from Portland to Freeport, or something like that. None of that is taxed. Personal, household, and business services. The bulk of this, $75 million, is haircuts, tanning services, tattoo services. You have somebody come in and clean your house. None of that's taxed. It's all excluded under our sales tax. But again, we provide you that information. I would also point out that a lot of these services, the categories, the titles of the categories, and what items are in those categories are based on the data that we get at the federal level. So there's a lot of federal data that we get from the Census Bureau that's based on surveys they do of establishments here in Maine and other states across the country. And they're the ones that kind of come up with these categories and make the determination of what falls under those categories. So in preparation of this, for instance, the ferry service from Portland to Peaks Island is under transportation services, and that would also include the whale watch. If you go out to see the whales or wherever out of Bar Harbor, I would have considered that amusement and recreation, but it's categorized as a transportation service. So these aren't categories necessarily that we've come up with. That just we're utilizing that data to try and estimate its impact here in the state. And then finally, exclusion of services for business purchases. So these are the big ticket items, services that businesses are primarily making. Financial services, legal services and administrative and support services, construction services. You see the big one is legal, business, and administrative and support services. So you hire an HR company to run your human resources department. You don't have in-office legal staff. You have to go out to a law firm. You can see that's quite a big number. All right, so that's kind of the rundown through what's in the report, how we categorize them, why they're there, how we estimate them. Happy to answer questions on that. The other last thing I don't want to forget is just, I said I would also mention, we do include a tax incidence study in the Red Book, again, so that all that information is available to the taxation committee in one spot. And I'm happy to talk about that, but it's really somewhat different from tax expenditures. So the other report that you're about to hear about, or the other studies or reports that come out dealing with tax expenditure reports, is the OPEGA evaluation report. So OPEGA is taking information from the Red Book, what we are looking at as a tax expenditure, and then performing an evaluation of it. And a lot of times we'll get into the discussions with OPEGA about, well, it may not really be a tax expenditure. We've included it again because we want to be as comprehensive as possible and provide as much information as possible. But, just so you're aware that they're taking that information from us. We've had situations where OPEGA has said, we think this should be a tax expenditure. We've thought about it. We've added it to our tax expenditure report. So it's been very helpful to have them looking at the report in preparation for doing an evaluation. And we have made changes based on their recommendations. So that's worked out great. Last thing I'll say is that we think highly of OPEGA. They're great to work with, but as the commissioner had mentioned today to the taxation committee in our orientation to them this morning, there's a lot of work that goes into that MRS does in administering the tax system, providing information to the governor, providing information to the legislature, and analyzing bills, preparing reports like the Red Book, revenue forecasting, etc. The OPEGA evaluation puts MRS, or the programs that MRS oversees through the tax expenditures, under constant review. And that does require a lot of our time in providing OPEGA with the information that they need to provide you with the reports. And so I think what the commissioner tried to convey to the taxation committee today is that we would welcome a review of the OPEGA tax expenditure evaluation process to see if we can maybe streamline it a bit, focus it a little bit more, not only to be helpful perhaps to the legislature, but to also take some of the time commitment that we find we're having to give to these evaluation reports. So I'll end there. I'm happy to answer any questions.
Thank you, Dr. Allen. Really appreciate it. Looks like Representative Hymanson has a question. And it looks like Representative Millett has a thumbs up. I'm not sure if he means thumbs up or if he means he just wants to give Dr. Allen a nice job. So Representative Hymanson, why don't you go ahead?
Thanks. Thank you for this review. If you could go back to when people move in and they're working here, but they work for a company that's in another state, can you just briefly go over how that's taxed so it's not double taxation? What are the rules now? Because that's happening a lot.
So as I said, this will be an area of discussion on Monday, but let's kind of go back before the pandemic, right? I'm a Maine resident. I live in Kittery, and I commute every day into downtown Boston to work for my employer located there. Traditional state income tax law would say I'm a Maine resident, so I'm taxed on all of my income, whether it's earned income or unearned income. But we recognize that the income that I earned in downtown Boston in Massachusetts is what's called is Massachusetts sourced income. Massachusetts has a right to tax that income because it's being earned within their borders. I'm physically there getting paid to work. And so Massachusetts taxes just that income that I earned there. Let's say that's ends up being $100. Then when I file my Maine resident tax return, I pay Maine tax on all of my income, including the income I earned in Massachusetts. But then Maine says, all right, we're going to give you a credit against your Maine tax for that $100 that you paid to Massachusetts. That way we're not double taxing it. We're basically, giving Massachusetts that $100 because that's where it was earned. And the same is true for people that commute into Maine and work. What happened after the pandemic, obviously, is a lot of people now are working from home. They're no longer commuting into their jobs. Massachusetts, early on in the pandemic, said, if you were commuting into Massachusetts on a daily basis, and now you're working from home in another state, in your home state, we're still going to consider that to be Massachusetts sourced income. We're going to continue to tax that. And, there's some quibbling about that. The state that is most up in arms about it, not surprisingly, is New Hampshire, because New Hampshire doesn't have an income tax. And New Hampshire is saying, how can our residents working here in New Hampshire have to pay an income tax to Massachusetts when they're not in Massachusetts? So they've taken Massachusetts to the Supreme Court. The court is going to determine whether they'll hear the case or not. We should be hearing from them soon. There was some hope that they would make a decision in December whether they would take the case. But what the governor decided just for the 2020 tax year is that we shouldn't punish Maine residents, right? Strictly speaking, we shouldn't give a credit for taxes paid to Massachusetts because in our view, that isn't income earned in Massachusetts. It's Maine sourced income. You were here physically in Maine. But the governor is proposing that the legislature continue to allow that taxpayer to get a credit for taxes paid to Massachusetts because both the employee and the employer did what Governor Mills and Governor Baker asked them to do, right? We asked employers to let people work from home so that the pandemic didn't spread. We asked employees to the best that they could to work from home. And the governor didn't want to see Maine residents get double taxed. So the governor is proposing just for the 2020 tax year that we continue to offer that credit paid to other jurisdictions if there are other states like Massachusetts asserting that sort of continued taxation of that income.
Thank you. Can I just one follow up on that?
Sure.
So this is going to be fluid because people are moving here not tethered at all to their place in Minnesota, and working here, and people will move in order to do that. So it'll be a fluid conversation that will outlast the pandemic. And we're hoping that it does because we're trying to get people to move here to do that specifically.
Absolutely. This is the pandemic has put a real test of these sort of issues before all the states. And I think we've all read the newspaper articles with the anecdotes about people moving to Maine. And I use the term move loosely. They've relocated to Maine for a period of time. because Maine it was considered to be, and is still considered to be, a safe state to avoid the pandemic. It gets very complicated about exactly when somebody becomes subject to Maine tax. There are some general rules, and we've actually put together a presentation that I'm not sure we'll get to on Monday, but we'll probably maybe get to when we get to the work session of tax. And we anticipate there will be some bills that deal with this sort of remote worker issue. And we have sort of these flow charts of kind of high level. This is, an example of somebody who's a Massachusetts resident, but has relocated to Maine for an extended period of time, and now they're working in Maine. What is their main obligation? And those are great, and I think those will be helpful for everybody. But a lot of times this really does get into very taxpayer-specific information about, you can have two people that look like they're in similar situations, and one probably is taxable in Maine and the other one isn't. And it's a very complicated area that this pandemic has really kind of brought to the forefront, just because people have been moving around like this.
Thank you.
Representative Millet, do you have a question?
Yes, thank you, Madam Chair. Dr. Allen, as you were talking about the definitions and how the estimating process works, I was looking at the governor's overview, in which, as you mentioned, you are required to show the exemptions or the expenditures by estimated loss of revenue. Since we will have to vote upon it at some point in the later stages of the biennial debate, could you give us just a broad picture of the general fund magnitude of the totals of your current estimates for the biennium upcoming?
That's in the tax expenditures?
Yes.
We purposely don't add them up just because of the reason that I said, that there's interaction between the two and they're all kind of estimated independently of one another. So we purposely don't add them up. But if we did, they'd certainly be in the, $1 billion or more on both sales tax and individual income tax, if you include all of those items.
You're suggesting $1 billion per year in combination?
Yes.
Thank you.
Any other questions for Dr. Allen? All right. Well, Dr. Allen, I appreciate it. And I think we will see you on Monday as well. Is that correct?
Yes. Looking forward to it.
Great. Thank you for this background information.
Thank you.
As both Dr. Allen and I mentioned, one of the things that government oversight did in recent years was asked to look at our tax credit programs and see if we're, I think in general, I would, in a shorthand way, say getting bang for our buck, that, they're supposed to be giving folks a tax break or tax incentive to develop our economy and therefore, generate revenue, generate jobs, generate economic activity. So I'm gonna turn it over now to some OPEGA staff who have been working on this. It's an ongoing process. It's not, at least I understand it's ongoing. We just heard from Dr. Allen about some of the challenges of it, but we have Jen Henderson and Matt Kruk here from OPEGA. So Jen, I see you got your face on the screen. Welcome. And I will turn it over to you. Maureen has put a couple of things in the chat for tax review I think, which is germane to Maine, and then the Pew Charitable Trust has some stuff to weigh in also on it. So Jen, go ahead, the floor is yours.
Thank you very much, Senator Breen. And I'd like to share my screen as well to share a PowerPoint if that's okay. Is that all right?
Yes.
Great.
Because you are a trusted member of Augusta's. Thank you.
Thank you. Can you see that okay?
Yes.
Wonderful. So yes, my name is Jennifer Henderson, and I am a senior analyst with the Legislature's Office of Program Evaluation and Government Accountability. And for those of you who are new here, we're also known as OPEGA, which is much easier to say. I'm here today with Matt Crook, who is OPEGA's acting director, to speak about Maine's tax expenditure review process. I'll keep it high level today, focusing on the process generally, but I'll also provide some additional resources for those who would like to dig into more details about the process or about any of the individual tax expenditure reviews that have been conducted to date. So Maine's current tax expenditure review process was established in 2015, and it was the culmination of a lot of work on the part of the legislature over a number of years. The purpose of the process really is to support the legislature's oversight of tax expenditures. At the time that the current process was established, Maine became one of only 19 states that regularly review their tax expenditure programs, according to research from the Pew Charitable Trust. And this is a level of review that moves beyond what Dr. Allen was talking about, where there's identification of what the tax expenditures are, to a further level of assessing whether those expenditures continue to reflect legislative priorities and are accomplishing things that the legislature has established them to do. The number of states that have these kinds of tax expenditure reviews has continued to grow since Maine joined the ranks. And as of fall of 2020, Pew reported that 30 states conduct some kind of regular review of their tax expenditure programs. Within this growing group, it's kind of exciting to note that the Pew Charitable Trust has highlighted Maine as a leader because they say that Maine has a well-designed plan to regularly evaluate its tax incentives, has experience producing quality evaluations with rigorous analysis, and has a process for informing policy choices. And for anyone who'd like any more detail about Pew's assessment of Maine's specific process, in the handouts, I provided a letter that Pew sent to the Government Oversight Committee in fall of 2020, and also some links to other documents where Pew discusses nationwide trends in this work, along with challenges and successes in evaluating tax expenditures. And I think Maureen might have put those in the chat as well.
Yes, they are in the chat.
Wonderful. So let's dive into how the process works here in Maine. It all starts with identifying the universe of tax expenditures that should be subject to the tax review process. And as Dr. Allen indicated, that does start with the Red Book and what all is included in the Red Book. The Government Oversight Committee is charged in statute with defining the universe of tax expenditures that should be subject to the review process, and then with categorizing each of the expenditures as to the level of review that it warrants. The three levels are defined in statute. They include a full evaluation for tax expenditures that are intended to provide an incentive for specific behaviors, that provide a benefit to a specific group of beneficiaries, or for which measurable goals can readily be identified. Then there are expedited reviews. These are intended for tax expenditures that implement broader tax policy goals and that may not be easily measured. And the third category is expenditures that don't get any review. That's for tax expenditures with an estimated impact on state revenue of less than $50,000 per year, or that otherwise are determined not to warrant a full or expedited review. And just to give you a sense of the scope of that universe, as of the last categorization that was approved by the Government Oversight Committee, there were about 177 total tax expenditures included in the universe. 32 of those were designated for a full evaluation, 82 for expedited review, and 63 for no review. The Government Oversight Committee updates that universe and the categorization of the individual expenditures within the universe annually to reflect statutory changes. And the committee also sets a review schedule annually to prioritize which tax expenditures should be reviewed next. And those decisions are made in consultation with the legislature's Committee on Taxation. Next, we'll talk just a little more about, for those expenditures that do get an expedited review or a full evaluation, what does that actually mean? What are those processes actually like? Expedited reviews are conducted annually by the Joint Standing Committee on Taxation. It's the committee itself that performs those reviews, which is one of the reasons why it always sounds a little strange to us when people call this OPEGA's tax review process, because it's not by any means OPEGA's, it's really the legislature's tax expenditure review process, and it's actually the Taxation Committee that is doing this piece of work. Each year, their work focuses on a specific group of expenditures.
Excuse me, Jennifer?
Yes.
I apologize for interrupting. Do you, on my screen, I'm only seeing one slide. It's oh, okay.
Sorry,
Now
my
it says-
bad. I forgot to advance them.
That's okay. We're all learning. So I appreciate that you let me interrupt. Sorry about that.
No, please interrupt, and I'm happy to take questions if you want as we go.
Okay, great. Thank you. We'll do questions after. Thank you.
So the expedited reviews, I was saying, it's the tax committee that does the reviews. And each year, they typically focus on a group that is clustered by tax policy area. For example, in the first year of this tax expenditure review process, the taxation committee focused on necessities of life. So that group included things like sales tax exemptions on groceries and other things like prescription medicines. As prescribed in statute, the taxation committee in their review assesses the continued relevance of or need for adjustments to both that broader tax policy area as a whole and the individual tax expenditures that are within it for the year. OPEGA supports the tax committee in its expedited review by providing the committee with a summary of information about the tax expenditures that are under review that year. And statute dictates that this summary includes information such as a description of the whole policy area, a description of each individual expenditure that's within the group, a legislative history for each individual expenditure that's within the group, and pulls together some estimated fiscal impact information for each expenditure and for the group as a whole. The committee then uses that information as the starting point for its review. At the conclusion of each year's expedited review, the taxation committee reports out its results to the legislature, and the committee is also authorized by statute to submit a bill to implement any recommendations it might have. And on the page of links that I provided, you can find links to all of the taxation committee's past reports. So that is the expedited review process at a glance. Now let's talk just a little bit about full evaluations. These are comprehensive evaluations that are conducted by the Office of Program Evaluation and Government Accountability in accordance with the review schedule that's set by the Government Oversight Committee. Full evaluations all begin, according to statute, with the establishment of evaluation parameters. The Government Oversight Committee sets these parameters for each full evaluation after soliciting input from the Taxation Committee and from stakeholders. And these parameters are really key because they establish things like the objectives of the evaluation, the metrics that should be used to measure the tax program's outcomes, and most importantly, the purpose and intended beneficiaries of the tax program under review. And I can't stress enough how important the established purpose and intended beneficiaries are. They really form the foundation for OPEGA's evaluation, and all of our subsequent work will refer back to those things as we consider questions such as, do the program rules and requirements support the purpose? Does the program deliver the benefits that the legislature expected to the beneficiaries that the legislature was intending to benefit? Or even, do other states have programs that are attempting to achieve a similar purpose? And how do their programs compare to the one that we're reviewing in Maine? Essentially, everything we do in a full evaluation comes back to those core parameters that are established by the Government Oversight Committee. Once those parameters have been set, OPEGA then begins conducting the evaluation as soon as possible. It's important to note that these tax evaluations don't always focus primarily on things like the ROI of programs or the budgetary impacts, although those topics may be part of a review. We often focus first on whether the programs are actually delivering the benefits that the legislature established them to deliver. And even figuring that out can be challenging, largely because Maine's tax expenditure review process is still in its early stages. Most of the programs we're evaluating were not set up to be evaluated, so they don't have clear purposes or goals often specified in statute. And in many cases, it may not be fully clear what specific return was expected for the state's investment and should therefore be measured. In addition, the programs often don't have performance data being collected to support calculation of basic metrics. And we frequently find that even when data is being collected, it turns out to be unreliable or incomplete and not particularly useful for the metrics that we're looking to measure. Another just quick note about these evaluations is that they do take time. When we're supporting the Taxation Committee in its expedited reviews, we're really just compiling data for them. But the full evaluations are a really different kind of effort for us. Like our colleagues around the country doing these kind of evaluations, OPEGA follows quality assurance procedures to ensure that our work is evidence-based, with conclusions that are sound and well supported. This includes internal quality controls, as well as opportunities for the administering agencies to review and provide feedback on our draft conclusions and reports, and to provide comment if they choose in the final report. Once all of the work is done, full evaluation reports are reported to both the Government Oversight Committee and Taxation Committee. And each of those committees has a statutory role in the receipt and processing of the reports. And of course, once reports are released, the data, recommendations, and policy considerations included in them also become available to the wider legislature for use in considering bills that propose changes to programs or enact new programs. On the resources list that I provided, I think you can also find links to all of the full evaluation reports that have been produced by OPEGA since 2016. And that's it for the overview of the tax review process generally. But if you don't mind, before we wrap up, I'd like to touch just briefly on the reviews that have been completed to date.
Sure.
A lot of work has been done in just a handful of years. In expedited reviews, the Taxation Committee has performed their expedited review of and reported out on 4 groups of tax expenditures already. And after 2 more groups are reviewed, all of the tax expenditures that were categorized for that expedited review will have been reviewed at least once by the Taxation Committee. And the goal of this process when it was set up originally was that there would be this cycle and that all of the expenditures in the universe would eventually get reviewed. In full evaluations, 5 reports have been produced by OPEGA to date. These include evaluations of the New Markets Capital Investment Program, Pine Tree Development Zones, the ETIF program, the Better and Betty programs, and the Maine Capital Investment Credit. OPEGA has also produced reports on 2 limited scope special reviews of tax expenditure programs, one on the design of the Major Business Headquarters Expansion Program when it was first enacted, and just a few months ago, a limited scope follow-up on the Pine Tree Development Zones program. At this moment, there are 3 full evaluations at some point in their process. The evaluation of the Seed Capital Tax Credit Program is in active fieldwork right now, with a report expected out in 2021. And there are 2 more tax expenditures that are currently in preliminary research, which is that phase where we're gathering information to support the Government Oversight Committee's establishment of the parameters. And those 2 tax expenditures are the Historic Preservation Credit and the Research and Expense Tax Credit. And they are expected to come before the Government Oversight Committee to have their evaluation parameters set early in 2021. And as I said before, links to all of the reports produced to date by both the Taxation Committee and OPEGA are included in the handouts. And you can also get hard copies of any of OPEGA's reports or executive summaries of reports or anything else like that by contacting our wonderful Administrative Secretary, Etta Connors, by email or by calling our office anytime. And with that, I thank you for your time today, and I'm happy to take any questions.
Thank you. If you could remove your screen share, then we'll have all of our folks in front of us again in front of us. Thank you. It looks like my co-chair, Representative Peirce, has a question.
Thank you so much, Madam Chair. More of just a comment than a question. Let me lower my hand so others can participate. I just want to thank you. Having been a member of GOC, I think you did a great job of laying out very succinctly the process that is involved. It can be somewhat confusing and there's a lot going on. So I really thank you for being here and having had you guys having been in GOC and having you come in front of us with your reports. The amount of work and detail that goes into what you do is just staggering. And you guys do an amazing job. And I'm glad that Pew recognized that at a national level. So thanks for being here today.
Thank you.
I have a question, but I'll let others go first if you'd like, if others have questions. Not seeing any yet, so I'll jump in. Would it be helpful or productive if when the legislature enacted tax programs, tax incentive programs, if we set out the parameters and the intended benefits right from the outset? So it seems to me like that would be part of a good piece of legislation, would be that, you're gonna forego certain revenue, but for certain rewards. And are there ways that the legislature could be doing that better?
That is definitely something that is really helpful to make sure that when we're doing the evaluation on the back end, we're evaluating the right things that you really cared about. The Government Oversight Committee sets those parameters, but they have a lot more to work with in setting those when that's been laid out in statute really clearly. And that is something that we have seen starting to change already when the tax committee has taken up tax expenditures recently, making changes to or enacting some, they have started to incorporate those. And it's a real improvement in our mind.
That's great. Any questions for Jen before she signs off? Representative Hymanson.
Yeah, thank you, Madam Chair. I'm trying to wrap my head around this because I think this is something I need to understand better. And so I appreciate understanding the process that's gone through. What I've taken away is that it's longer than I thought. The answers are not as clear as I thought they would be. And that to get better answers, we need more hands-on so that the people of Maine understand where they're, if what they thought was happening with these tax incentives is really happening. So I'm just layering on, that's not a question, I'm just layering on my understanding of this, and I'll ask more questions of taxation. And as this is the problem of not being there and running into people in the hallway to say, you know, let's sit down for the cup of coffee and understand what's happening with this, but I will do my best. So thank you for that presentation.
You're welcome. And if it helps at all, we're happy to take questions at any time. You can reach out to us via email if you have questions about specific reports or the process generally.
Okay, I don't see anyone else raising a hand. Oh, Representative Peirce, are you raising your hand?
Here we go.
Oh, great. Go for it.
Well, I just wanted to give the opportunity for the acting director to say a few words if he wanted to. I know they're in transition there with Danielle Fox moving over to OPLA, but thank you for joining us. Mr. Crook, is that the correct pronunciation?
Crook.
Crook. Peirce, Pierce, Crook, you know, there we go.
I know the struggle. I really don't have a lot to add. When we got the request to come before AFA, I panicked a little because I don't personally work on tax expenditures. And normally this is something the director would certainly show up and do. So I wanted to be respectful and do so. But Jen has been here since the beginning and has forgotten more about tax expenditures than I'll ever know. So you've heard the presentation from the foremost authority.
Great.
Thank you.
All right. So I think we will move on now to make sure I have my agenda up in front of me. One moment. I gotta change my screen. Sorry, bear with me. There it is. Okay. So thank you to Opega for joining us. And we're going to turn now to our last group of presenters on this theme of, you know, how different ways we support economic growth. We have with us Commissioner Johnson, who is Commissioner of DECD, Carlos Mello, who is the acting chief director of FAME. I think we all know Bruce Wagner is retiring, and Brian Whitney, president of MTI. These are FAME and MTI are the bigger sort of economic development operations that came to my mind. They're not the only ones, so I suspect we'll hear more from Commissioner Johnson, but I wanted folks to understand, because there will be research and development bond proposals that come before us. And so I wanted to have everybody just get some background information on, you know, when we pass a bond, the bond gets sold, and then what? You know, there's a process that it goes through, the money goes through before it winds up at its end user. Sometimes that's through loans, sometimes that's through competitive grants. There's different mechanisms. And so today my hope is we all just get some background on that, on some of those mechanics, so that when we have those bond hearings, we'll have a little bit better understanding of the big picture. So there is Commissioner Johnson. Thank you for joining us. And do you have something? Yeah, Maureen has posted the DECD presentation in the chat. But I think we're still at a point where we would welcome a screen share from you, Commissioner, or from Kate, either one of you, if you find that would be possible.
Yes, absolutely. Thank you.
Thank you.
Just there. So, can you see that okay?
Yes.
Great. So good afternoon, everyone. My name is Heather Johnson. I am the Commissioner of the Department of Economic and Community Development. Thanks for having us this afternoon. I think this is a really great discussion. And this is like, I caught just pieces of the earlier discussions. I think this discussion, like those, there are a lot of layers to these types of discussions. So I hope today we will set the stage in an effective way, but certainly very open to ongoing discussions about how we focus on economic recovery. What are some of the financial levers that we have for all of us to use together as we look at recovery? So I'm going to start, then I think the Deputy Commissioner at DECD is going to do a couple of pieces on bonding, and then we'll move into Carlos. So first off, for some of you who may not be familiar with the Department of Economic and Community Development, just a 2-second background. We do a number of things within our department, but our whole goal is to foster economic growth and diversification in the state. We have a team that works on business development. Inside of business development also sits the Maine Rural Development Authority. Maine Rural Development can lend money to very particular industrial sites across the state. It's fairly targeted at rural redevelopment work. So think industrial sites that have closed or need significant change as they move forward. So that group is right now only lends money. They have at times been awarded special allotments to be able to put grant funds out as well. We have a team that focuses on tourism. They are able to grant funds through tourism. Outdoor recreation is a new office for our department. They have actually received a pretty significant grant in from USDA that they can then utilize to support businesses in the outdoor recreation field. Community development is where the federal block grant program comes into the state. And that's about $11.5 million a year that is then awarded out into communities in a variety of mechanisms. But that is all grant funding that can be recapitalized in some cases. Obviously, broadband, there is a bond that is currently active, a $15 million bond for broadband right now that is in the process of being deployed. So we can talk a little bit about that. And you'll hear more about the Maine Technology Institute in a minute. Brian will talk through that. So as you think about economic development, again, a lot of economic development and really effective economic development happens really close to communities and projects. And so one of the things DECD does as a financial lever is has significant number of organizations that we pass funds through to. Some of them, the funds go in order to match annual federal funds. Some of them are a statutory obligation that we have to move money. The legislature has determined that we need to move money to particular organizations to empower them to do the work that they do. And some of them, it moves through DECD for very mission-specific projects. So this is work that we do annually. Additionally, we certainly are active in trying to attract additional funds to the state that may go to these groups or to others. So that's work that is ongoing. And again, are different pieces of the financial picture as we move forward. And with that, I am going to introduce the Deputy Commissioner at DCD, Denise Garland, to take us through the next piece.
Hi, good afternoon. Denise Garland, Deputy Commissioner with DECD. So yes, I will happy to chat about the bonds when they are assigned by the legislature and designate DECD as either the receiving agency or the pass-through agency. So once the bonds are approved by the voters, and there are several steps to actually awarding the funds, so hopefully I can help answer any questions or at least guide you through that process. So once the bond funds have been assigned to DECD, we work with the receiving agency. I'm going to use MTI as an example because you're going to hear from Brian a little later on about how his process works when he actually receives the funds and what he goes through. So MTI may be designated in the legislation itself to come through DECD and could be for a specific project, several projects. And so we work with MTI as to when they might actually need the bond funds, because that's critical. We then need to work with the Treasurer's Office to see when the next bond sale is. Do they need the funds before the bond sale? Could we borrow from the Treasurer's cash pool to make that happen? Usually when MTI is involved, those bond funds involve an RFP process and they're competitively awarded. So chances are they're not actually going to be needed from the bond sale until sometime in the future. So we'll work, there's some forms to be filled out with the Treasurer's Office. And then once we've decided, you know, when the funds are going to be needed, we're going to need to work with the Budget Office and coordinate an account that needs to be set up for each of the bond accounts. And that's timing of the bond sale. Once we've got that all in place, then the contracting piece works. We need to establish a contract, usually using the language from the intent and content in the legislation, from the Secretary of State's office. We put that into the contract itself to facilitate the transfer of the funds from DECD to MTI. All right, where am I going? I'm lost with this stuff. I'm sorry. If it's over $1 million, then it goes through another level of review. So even though the voters have approved it, we've got a contract in place, we know according to legislation we've got to give it to MTI, it still has to be approved by the state's procurement review team to actually approve the $1 million to go out. Once all that is in place, it's all been approved, we can facilitate the transfer to MTI. And that's where Brian and his team get involved and they can share that piece. So that's the process if DECD is the pass-through agency. If we're the recipient agency, which we have been on a couple of cases, and as Heather's probably chatted in the past, we don't have an extensive staff at DECD. So we call together who we can to get these things to work. In the past few years, we've had a couple of dedicated projects. One was funding for a marine jobs economy. So obviously we needed to work with Department of Marine Resources. We put out an RFP. We actually recruited MTI to help us with the disbursement of the payments to the awardees on that project. And we currently have one on the books right now where DECD was the recipient agency for some funding for the Gulf of Maine Research Institute. So we've drawn the funds from the treasurers from the bond sale. We have a contract in place for the Gulf of Maine Research Institute, but we have not given the funds to them yet. We're waiting. What are they going to spend the money on? Because I believe we are then responsible as the recipient agency to make sure that the money is being spent on what the voters approved. So that's still in process, and we're in communications with GMRI constantly on that project. So I probably rushed through that, and I apologize, but that's kind of what happens when bond funds come through DECD.
That was very simple, to the point. I like it.
Okay.
Yeah.
it is a little bit of work in the background, but hey, it's all very important stuff.
And Senator, if I could jump back in for a second.
Sure.
So just one thing to note, when we administer bond funds, funds from the bond can't be used to do that administration work. So those funds have to come from someplace else, either general fund or you have to be able to do it within your own purview or the funds that you already have. So that's just an important piece as you think about allocating out kind of work related to bonds. That work has to be into the standard purview of the finances already existing.
Thank you. Mr. Mello.
Thank you. Senator Green and Representative Peirce, distinguished members of the Appropriation and Financial Affairs Committee. My name is Carlos Mello. I am the acting CEO of the Finance Authority of Maine, and I live in Camden. I'm very happy to be with you today. I would like to first extend Bruce Wagner's best wishes to the committee. He had hoped to be able to be here, but he had a personal commitment that he could not reschedule. He wishes to thank all the committee members for their support of the Finance Authority over these years and the support you've given him. So I wish to pass that along.
Thank you.
So let me talk about the Finance Authority of Maine's FAME's business programs. FAME's mission is to provide financial solutions that help Maine people achieve their business and higher education goals. We do that through a number of programs and partnerships in the state. First of all, the one that you may know the best is our commercial loan insurance partnership that we have with lenders. And when I mean lenders, it includes commercial bankers, savings banks, credit unions, alternative lenders who are extending commercial credit into the state. We also make direct loans to businesses who either due to their stage in development, being a startup or of some other ilk, their inability, thank you. I'm probably going to deviate from that a little bit. So if it's easier to see me, it may be, we don't have to have it up.
Okay, more importantly, I just figured out how to screen share.
That's wonderful.
So if you don't want me to put it up, I'll figure out how to take it down. What's your preference?
My preference would be for you to take it down, and then
okay.
and it's background material for you all.
Okay, fair enough. Thank you.
Thank you. So as I was saying, we partner with about 40 institutions in the state, and that includes both Maine-based companies as well as non-Maine-based companies from elsewhere around the country. On direct loans, we make those loans, as I was saying, for startups and other other companies who are unable to attract credit due to their risk profile. They may have gone through difficult times. It was originally funded under a program called the Economic Recovery Loan Program that was set up by the legislature. Though that program the statute requires that they not be, that the borrower need to have tried to get funding elsewhere before they come to the Finance Authority of Maine. Those two programs in fiscal year 2020 resulted in 78 million in debt capital to 337 Maine companies, supporting over 5,000 businesses. 5,000 jobs. So that's a wonderful 1 year, but I think it's important to look at it from inception and what the state's invested. The state invested over time $37 million into the commercial loan insurance program. Over time, the state has invested about 18 million into the direct loan program. That combined $55 million worth of investment has resulted in direct issuance of $1.4 billion in debt, in indirect equity and debt capital totaling together over $2 billion, 1.4 billion plus to get to over $2 billion in capital brought into the state through the Finance Authority of Maine's efforts. And over 100,000 jobs being supported. So if I can ask you to have ready for your elevator pitch, if someone asks you about the business activities of the Finance Authority of Maine, say that we've invested $55 million into it and we've supported over $2 billion in capital and over 100,000 jobs. In addition to those activities that we do today, in those two programs, we also administer the tax credit programs directed towards businesses in the state. First being the seed capital tax credit program. And I want to thank the legislature for increasing that annual credit limit from 5 million to 15 million in the last session, as well as the state new markets tax credit program, which has essentially been exhausted and I know comes before this august group periodically for reconsideration, and we'd ask you to reconsider it again. In addition, we are a conduit issuer for bonds in the state. And by doing that, we essentially allow not-for-profits and municipal related revenue projects to garner tax-exempt status, reduce their cost of funds without the state taking on any credit risk associated with that or having any responsibility to repay. Over a 5-year period, we did over $400 million in those bonds. And one of the ones that was of most note was a 95 million bond. And then we had a subsequent follow-on issue with Maine Health so they could comply with the ACA provisions for documentation and electronic medical information. In addition, we partner with the Department of Agriculture. We administer the Agricultural Marketing Loan Fund, the Potato Improvement Fund, the Dairy Improvement Fund, and the Nutrient Management Loan Fund, all under the auspices of Commissioner Beal. As we indicated, or Heather indicated before, MRDA, the Maine Rural Development Authority, we're the administrator for that program in partnership with DECD. And we partner with the regional economic development revolving loan authorities or loan agencies across the state, totaling about 26, so that funding that this legislature provides allows them to act on a local basis. So to bring my prepared comments to a close, I'd like to also mention a couple of other things. We also support the Maine Venture Fund, who is another enterprise that is worthy of consideration and is an important part of the economic engine in the state by investing in startup and growth opportunity companies and equity capital. And I know that the committee has had discussions about how do we get more equity into those companies. And lastly, the state 10-year strategic plan, as well as the Economic Recovery Committee recommendations, have noted the opportunities to put additional funding into FAME to be able to expand our commercial loan insurance program so that we can meet the needs of larger exposures. We are limited by statute and by the amount of capital that we have to only do about $5 million in what we call credit exposure to any one borrower. A further investment would allow us to do to greater amounts, as well as being able to enhance and increase the dollar amount that we're able to do for customers who utilize our online answer program. That online answer program allows our financial partners to get an immediate decision on loans up to $1 million, FAME exposure up to $750,000. And that is the growing part of our business because it meets the needs for speed, ease, and deployment that you all have heard that have come through from our businesses in the state to be able to do that. And we empower our partners to be able to accomplish that. With that, I'll leave any questions.
Thank you very much. Any questions from the committee for Mr. Mello? Representative Arata.
Thank you. I was just wondering, have you had many losses due to the COVID pandemic?
We've actually set aside additional reserves to be able to help that, both on a direct loan basis as well as supporting companies through our commercial loan insurance program. To date, we have not incurred substantial losses. We have allowed our insured partners to defer payment. We have supported them in allowing them to work with customers to be able to do that. We are very proud that the money that's been invested in us, we've been able to maintain over these years and maintain the capital. That is both a great, it's a great honor of being able to have been good stewards. So the return on investment on what the state has invested in us as capital effectively is infinite.
So before COVID, did you have much for losses?
We target about a 4% loss rate, which is 3 to 4 times what a commercial lender would do. And for our commercial loan insurance programs, and we're about 15% on our direct loan programs. And that's just indicative of the risk. We want to take that risk. We've built our models so we can sustain those programs at those levels of risk.
Okay, thank you. Have your loans included commercial real estate, or are they just for equipment startup costs?
We are precluded from doing speculative commercial real estate investment. We do that in partnership with MRDA for redevelopment. By statute, we're required to only do commercial loan insurance or direct loans on companies or properties that are 51% owner occupied.
Thank you.
Any other questions? Representative Martin.
Thank you. Quick question on the status of the available money that might be coming from the Economic Recovery Committee recommendation in November.
Yes. Would you like me? I'm sorry, I didn't know if I followed the question.
Yeah, well, there was a part of in the report, the status talked about the fact there'd be additional money probably coming from the Economic Recovery Committee recommendation, and wondering where that was at this point.
I will defer to Heather to Commissioner Johnson as to where the process is on the funding of the Economic Recovery Committee's various recommendations. I can speak to what they were suggesting, and that the additional amounts invested in FAME would do the following. It would allow us to make larger loans, helping start larger enterprises to therefore have bigger economic output and impact. We would also be able to we would also be able to do larger small loans. And one of the things that we've heard from our lending partners is in this environment where companies are struggling to get through, they need as streamlined a credit process as possible. Allow us to do more than the $1 million loans that we're doing now on an expedited basis using the processes that we built. The other thing that we're working towards is to be able to support the broadband initiative and working with Connect Maine Authority to seed funding into Connect Maine so that we could help support either a commercial loan insurance-like program or a direct revolving loan program to help support broadband development in the state. Those are some of the suggestions that I made.
Okay, thank you.
And just, John, you know, there might very well be a bond proposal coming from the administration, but I was very clear with folks from the administration that we weren't there yet. We were just doing background information, and that they were, you know, we'll get to bonds, the more specifics when they come, or whoever comes forward with bond proposals. So,
Thank you. Well, I was wondering about the figure as to whether or not that had been agreed to, or, but obviously that at this point, that's not been the case.
we're not there yet. Any other questions for Mr. Mello? Don't see any.
Thank
Madam,
you very much.
my co-chair, did I miss anything? No, okay.
I don't think
Thank
so.
you.
I didn't see anything, so.
Okay, great. Thank you, Mr. Mello. Hello, Mr. Whitney, how are you?
I'm doing well, thanks.
Good, thank you for standing by with us and listening in, and we're ready for you. And if you want, you can share your screen, or I could share your PowerPoint. What would you prefer?
Let me see. Let me see if I can do it.
Oh.
Can we see that?
Okay, I can.
All right. Oops.
Ooh, fancy.
Well, great. Well, Senator Breen, Representative Peirce, and esteemed members of this prominent committee. My name's Brian Whitney. I'm the president of the Maine Technology Institute, our state-funded public-private partnership that helps drive innovation in Maine. As you can see from the slide in front of you, the Maine Technology Institute is our industry-led, publicly funded nonprofit corporation. We offer early stage capital and commercialization assistance in the form of grants, loans, and equity investments, as well as entrepreneurial guidance and mentorship to achieve our core mission. Created by the legislature and governor in 1999, MTI's establishment was largely driven by the work of two joint select committees on research and development that were convened by the presiding officers way back in the 118th and 119th legislatures. Those two joint select committees really created the framework for Maine's R&D programs and designated that those initiatives ought to focus Maine's investments on 7 targeted technology sectors, which I'll allude to in a minute. Over the past 20 years, MTI, working with our partners across the state, have focused our efforts on helping to diversify and grow Maine's economy through investments in those 7 targeted technology sectors. Today, MTI remains the state's only source of private sector focused R&D financing, leading to new products and services, job creation, and other economic benefits. Since its inception, MTI has dispersed over $280 million in nearly 3,000 distinct projects, leveraging well over $1 billion in private sector matching funds. MTI supports innovative projects that share our portfolio goals of creating and retaining quality jobs, growing and accelerating revenues, and attracting and leveraging additional capital and other investments. As I mentioned, MTI is an industry-led entity. We're a public-private partnership, and that public-private partnership largely consists of a board made up of 15 members, 10 being private sector appointees by the governor and 5 members representing some public agencies. We also have 7 subsidiary boards made up of about 120 subject matter experts. Each of those represent those 7 targeted technology sectors that I alluded to earlier. And they're really the special sauce for MTI. These are folks who volunteer their time to review our proposals and provide us the technical, they let us know how well the products will do in the marketplace and whether they have merit technically and scientifically. And like I said, they're really the special sauce of the whole organization, and that's another key component of the private sector and public sector partnership. Here's a quick slide on FY20 funding from MTI. We deployed $9.6 million. And as you saw on Commissioner Johnson's slide, MTI gets about $6.5 million a year in an appropriation. But due to some loan repayments and investment returns, we were able to put even more money to work than we got from the state this past year. So 9.6 million actually went out the door to 140 distinct projects. And that funding helped leverage $58 million in private sector matching funds. So this slide's important because MTI wants to make sure that any of the projects that we invest in have some skin in the game. So for every dollar that MTI invests, we expect the applicant to put at least $1 into a project. This past year, we actually leveraged $6 for every dollar in MTI funding. And this shows how year over year that's increased the last 4 years. 2018, I will note, is an anomaly. The 5.5 million there is MTI core funding. That year, we also administered a $45 million R&D bond, as well as a $7 million Marine Jobs Economy bond. So that year, we actually put $57 million to work in total, and that leveraged an additional $240 million. This is a slide on the awards by month this year. The reason I used this slide is because I wanted to demonstrate how MTI had altered its process in mid-March to make sure we were being responsive to the needs of innovators across the state during the pandemic. We actually put half of the annual total dollars to work in the last 4 months of the fiscal year, which were the first 4 months of the COVID pandemic. This slide actually articulates the 7 targeted technology sectors that I've alluded to on a couple of slides earlier. This gives you a sense of what those are. Typically, information technology and biotechnology are the sectors we see the most activity out of, but I think it's encouraging to note that they were both surpassed this past fiscal year by the aquaculture and marine sector. So there's a lot of activity going on in that sector. So MTI made a strategic decision about its risk profile during our strategic planning exercise a few years ago, and our board determined that it was much more comfortable taking big risks with smaller dollar amounts and smaller risks with larger dollar amounts. So this slide demonstrates that approach. Our range 1 awards are typically $25,000 or less. We did 58 of those this past year. Range 2 is $25,000 to $100,000. We did 29 of those. The next one is $100,000 to $250,000, and we did 12 of those, and the final one is over 250,000. So you get a sense of how we assess risk as we're looking at these projects. So this past fiscal year, we actually had 2 million in bond funding to award. So we developed a program and we solicited proposals for it. There was significant interest in that $2 million. In our request for proposals, we capped the amount entities could request at 500,000. We actually got 84 proposals seeking in the aggregate $25 million for the 2 million that was available. Ultimately, we made 10 awards. We augmented the 2 million that we had with a little bit of core MTI funding. Those 10 awards leveraged an additional almost $32 million in private sector matching funds, so a 14-to-1 ratio. And that $2 million will end up creating or retaining 1,600 jobs, which is a pretty good return on investment. It's like $1,250 a job, when in typical economic development investments, 30,000 to 60,000 is the norm for economic development incentives. MTAF 2.0 is the bond that we administered in 2018 that I alluded to on the previous slide. That was a $45 million bond that was passed by the legislature and voters. MTI administered that program, issued a request for proposals, and there was robust interest, as you might expect. We received 183 applications seeking in the aggregate $400 million for the 45 million that was available. That was a program where we didn't cap the amount people could request, and we received requests everywhere from $50,000 to 45 million. So we had one bold applicant seek all of the money. They weren't successful. So ultimately we made 18 awards. Regrettably, we were really popular when we had the 45 million to deploy. But once we made funding decisions, I was wildly unpopular, having said no to 90% of the applicants. So we ended up putting 46 million to work. That leveraged 192 million in private sector matching investment. Ultimately, according to an independent economic impact analysis, those funds will create 5,350 jobs and generate $1.4 billion in economic impact in the state. There are some other bonds that we've been administering over the last 6 to 10 years. I've listed them here so you have a sense of some other work that we've been doing on the bond front. And prior to appearing before you this afternoon, I understood there were some questions about what happens once you pass a bond, once voters have their say. And so I got a few slides here. I know Denise alluded to some of this, so it might be a bit of a review. But once a bond is approved, what happens next? In our experience, and as Denise noted as well, once the voters approve the bond, there's a multi-step process before that funding actually gets to MTI. Once the bond's sold on the bond market by the state treasurer and the proceeds are realized, those funds are then made available for DECD to draw down and pass through to MTI via a DECD MTI contract. MTI then uses the language in the bond bill and the intent and content guidance provided to voters by the Secretary of State, and we develop a competitive funding process. We conduct outreach, we do education statewide, we issue a request for proposals, we receive those proposals, then we conduct due diligence and ultimately make funding decisions. How are the bonds operationalized at MTI? As Heather mentioned, Commissioner Johnson mentioned, bond proceeds cannot be used to pay for administrative costs. So to date, MTI, when it has a bond to administer, we are using our annual general appropriation to help cover those costs. In at least one major bond bill development, I might note, the legislature actually included a supplemental general appropriation to MTI to administer the funds. So obviously it wasn't part of the bond, but it was part of a supplemental appropriation. But in most cases, MTI is absorbing those costs internally, which can be substantial and definitely absorbs a significant amount of staff time. It's important to note that interest income accrued on any bond that's managed by MTI and not yet dispersed to recipients is actually returned to the state treasurer each quarter. So in the past 2 to 3 years of administering the most recent $45 million bond, MTI has actually returned nearly $1.2 million in interest to the state treasurer. So we get a really good interest rate, and being good stewards, that money flows back to the treasurer's office. Uses of bond money. So MTI has worked with the Attorney General's office over the last 20 years to get guidance from them. And the guidance that we've received tells us that bond money is to be used for capital assets, facility construction, renovations or land purchase, equipment, certain technology upgrades, etc. So as a result, MTI award recipients, in addition to providing detailed scopes of work, equipment lists, and budgets, are also asked to certify in writing that any of the items purchased with bond proceeds are capital expenses and are carried on the organization's balance sheets and declared in tax returns. So we go that extra step to make sure MTI and the state's insulated. Got a couple of slides on some FY20 success stories. We had a number of MTI companies make some amazing operational pivots to help address some of the needs due to the pandemic. Flowfold and Gorham is one that pivoted to make face shields for hospitals. Stark Systems is a company that makes modular walls, and they actually pivoted to help construct isolation rooms for infected COVID patients. And this company, Stark, has just been incredible. They're an amazing MTI success story. The two founders of the company actually met at an MTI networking event. We provided the company some money to do some proof of concept work and prototype development. We provided them a little bit more money, which is really the MTI model, eking out money for various projects, and then helped the company get its prototype to market. And now the company is just doing amazingly well, operating on Brunswick Landing and having taken advantage of the Tech Place incubator on Brunswick Landing that MTI also helped provide funding to get started. So really good story, Stark Systems. UMaine Composite Center, I'm sure you all know that the world's largest 3D printer is now located at the University of Maine in Orono, and MTI helped provide some funding to make that project a reality. MTI's statute tasks MTI with making sure that there's a complementary system of supports for innovators in our state. So we work with all the partners on this screen and many more to make sure that there's mentoring available, counseling available for innovators, that there's pitch competitions, accelerators, business incubators, a whole host of different activities occurring in the state have been touched by MTI to make sure that this ecosystem is a thriving and robust one. And that brings me to the end of the presentation. I'm happy to take any questions that you may have.
Thank you, Brian. Would you, you're going off the, oh, great. Then I can have faces in front of me again.
Yep.
It looks like Representative Peirce and Representative Hymanson have questions I can see right now. Representative Peirce, why don't you go ahead?
Thank you so much. I had two quick questions. Of the first kind of, you talked about a group of people that applied for the bonding that was available, and some of those were out of state, and you awarded 10 of them. I'm trying to remember the slide. Were any of those out of state people, or was there a percentage that you brought in, or did those not work out?
Yeah, there was one that we awarded that had planned to establish operations in the state, and ultimately they weren't able to execute, which is why we had $2 million to deploy this past year, because that company ended up forfeiting the award because they couldn't follow through with the commitment.
Yeah. And then my other question was, there seems to be you pivoted well during COVID for logical reasons, but I'm wondering are you going to just go back to the business as usual, or are you going to take some of that amazing amount of investment that happened around that and incorporate that into something going forward post-pandemic?
Yeah, we're in a mode at MTI of continuous improvement. So we are always looking for opportunities to improve, and it's almost physically exhausting that, I've been at MTI now 6.5 years, and it seems like it's been constant change and improvement. So yes, always looking to stay on the cutting edge.
Thank you.
I saw your mouth move. You were muted.
Yes, and then Representative Fay. Thank you.
Thank you for the presentation. I noticed on your slides as you went through that the more we give, the more we get. So I wondered if there's been an evaluation of that, like how much should we be giving to get, what's the capacity out there for the state to develop what's out there to be developed? Because it seems like, your ROI is fantastic. And I'd like to know, what our shortcomings are in giving money to these programs.
Right. Yeah, I don't want to get out over my skis with the administration or Heather, but as you saw from the bonds that we administered, the demand for those products was 10 times what we had for available funding. I was encouraged to see that the governor's economic recovery committee had some recommendations around innovation spending, and I'm encouraged to see that and hopeful that that might go somewhere. But as I said, don't want to get out over my skis on it, but I think there's definitely sufficient demand.
Yeah, I'd like to recall the economic recovery group's recommendations. I know I have that somewhere, but if somebody has that more accessible, could you put that in the chat, that particular page, or email it to me, or just so I don't spend a whole morning trying to find it?
I'll email it to you. Happy to do that.
Thank you.
All set, Representative Hymanson?
I am.
Great. Representative Fay?
Thank you. This has been a really great presentation. I really enjoyed it. Back to one of the earlier slides where you talked about increased output at the beginning of COVID in March, April, May, and June. First of all, I'm impressed by the nimbleness of the ability to do that. But and I think you may have answered this question in your success story section, but were most of those funds used to help businesses pivot? Were they used for helping them cope with COVID. Could you just kind of describe a little bit about what some of that increased output went to be used for?
Yeah, absolutely. That's a great question. So it was a combination of things. We actually we were pretty liberal in offering deferments to folks who had loans with us. So we routinely offered people a 90-day deferment of any loan repayments. We also, as you might expect in the pandemic when it first emerged, there were a number of companies in the MTI portfolio that were in the process of raising investment rounds. And that really dried up overnight. And those companies needed that money to continue to scale and grow. So MTI stepped up and helped fill that void with some additional investment in those companies. And then we actually put together a expedited decisioning process for companies that had COVID mitigation solutions. So companies that were pivoting in response to some of the needs of the pandemic. So we really sped up our decisioning process for those so that those folks could get those products to market as quickly as possible.
Any other questions?
It's great to see so many familiar faces. Hello, everybody.
It's good to see you too. And it's amazing what Maine's business community has done over the last 10 months. It's amazing.
It's really true. And, I'm sure Heather will be, broadcasting this widely, but, Maine was really a global performer during this pandemic, with Puritan and Abbott and Jax and other folks that really stepped up on the global stage. IDEX, exactly. So Maine really, I think, showed itself to be a leader, as we all know it is.
Yeah, it's great. All right, so I think as far as I can see from the rest of my committee, we're going to say thank you to our invited guests and ask you to sign off. And we're just going to talk about some business, tee up some business that we're going to be tackling next week. Just do some housekeeping. So
Thanks so much, everybody.
Thank you, everyone. Thank you, everybody, for attending these background sessions. I hope they were helpful. And, we'll continue to talk about some of the things that we covered as, different things come before us. Just wanted to make sure, Maureen, if you want to show your lovely face and just make sure everybody understands what's happening next week. We're going to talk about tax on Monday, and you've all gotten the schedule. I think Maureen has been really helpful sending out the Zoom links to different chunks of the week.
Definitely Mandy. She has been instrumental in
Did I say Maureen? I meant Mandy.
Yep, that's fine. We sometimes think of ourselves as interchangeable, but not in this case because I could not do what she does. So
yeah, well, it's been great. So, we're deliberately starting at 10 and giving everybody plenty of time. We won't go all day if we don't need to go all day, but this will be our first attempt to really have the public involved and giving testimony. So I'm a little nervous, but I think that these briefings maybe were a good trial run. And one of the reasons I wanted to do the screen sharing thing is because we're really being advised not to have people share their screens. And in fact, the attendees who will be speaking next week from the public won't even have the capacity to share their screen, I don't think. No. So anyway, Any questions, technical, procedural, anything else before we sign off? Yeah, Patty, go ahead.
Just so I am right about this, because I already see them in my email, but I haven't really, gotten myself organized around this. So for each day, will we have 2 Zoom links, one for the morning, one for the afternoon? No. Okay.
Go
Just
ahead,
the one-
Maureen.
Just one per day. We decided that even though there are some days that have separate blocks, having only one Zoom link a day would make your lives easier. And so yes, so the policy committees can pop in when their hearing block is scheduled, but and stay if they want, I suppose. It's up to you, but certainly we respect the fact that it's going to be tough on you. And if you're taking a break, Mandy says she can put up a sign that says, on a break, guys, public, come back in a bit and see how it resumes. Especially since some of your meetings may not be as long, as the blocks that we carved out for them. So.
Okay. Thank you.
John, go ahead.
Yeah, will the public be able to ask questions, or they'll simply present evidence and can we then ask questions of the public?
It's going to be a lot like regular sessions in the room. So we'll have the member of the public come on and give testimony. And then if you have a question during their testimony, you can do your hand raise thing, and one of us will acknowledge you and you can ask a question of the testifier.
So it's also important to share that Commissioner Figueroa will be coming and giving her testimony about the supplemental budget first. Right. And she'll do that every day based on the sections. So we'll have opportunity to ask questions or ask them to bring something back for work session, just like if we were in the room. And then we'll invite public in to testify after that.